Welcome to my channel. I'm Scott, and in this video I'm going to walk you through the process of valuing Preformed line product stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. Let's get started with the model. This is a small cap company, 640 million market cap. They're trading at $130 a share and a minuscule 5 million shares outstanding. I think this is the least amount of shares outstanding I've seen on a stock. This company designs and manufactures products and systems that are used in the construction and maintenance of underground networks for the energy, telecom, cable, data communication, and other industries. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. 15 million of free cash flow in 2021, a negative in 2022, but it looks like they invested a lot into CapEx because they had positive 54 million of net income. Then they had their best year, positive 72 million in 2023, 11% margin. It dropped to 57 million in the trailing 12 months. Net income is the profit or loss on the income statement. It's revenue minus expenses. And that's around $50 million a year on average. Margins between 7 and 9%. Revenue is the sales for the company, and that went up from 517 million to 670 million, but then came down 6% in the trailing 12 months. Their revenue per share is almost equal to their share price. That means their price of sales is about a 1. And they pay a dividend of 0.62%. We estimated 4 years of future free cash flows. We also estimated the terminal value, it's all cash flows past year 4, that's 1.9 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $1.6 billion. We divide that by 5 million shares. And we get a calculated stock price of $318. They're trading at $130, so they're trading at a 59% discount. It's a really strong buy according to the model. And I gave them a higher WACC than they should have gotten. The WACC should have been 10%, which would have given them a stock price of $410. When I do a DCF, it's a prediction of the stock price within the next year. And I thought that was a little too high, 400, so I lowered it to 300. There are 26 companies in the same industry as PLPC, and if they have a number in red, they're worse than the median. If they have a number in blue, they're better. They don't spend much in CapEx, 25 million, about the median. They have a good debt to equity ratio. For every dollar of equity, they have 20 cents of debt. They are paying a dividend, so they could afford to give money back to the shareholders. It's a small dividend, equal to the median. Energizer Holdings, it pays the biggest dividend, 4.3%. They generate a good amount of free cash flow, more than the average. They rank 16th in market cap, 641 million. They have really good price multiples, all better than the median. They're trading at 11 times free cash flow, which is a good multiple, 12 times earnings. Their revenue is very similar to their market cap, which is why their price of sales is 1.0. But it's actually a little higher than 1.0. If you move the decimal point out a little bit, you'll see it's probably like 1.03 or something. And their 5-year annual revenue growth rate is 8%, in line with the median. If you put $10,000 into this company 10 years ago, you'd be at $27,000 today, a 10% annual return. That's not too bad. Let's take a look at their latest income statement. Revenue is down. In the first quarter of 2023, 180 million. In the first quarter of 2024, 141 million. Let's see if they give a breakdown of that revenue. Of the 141 million of revenue, 71 million is in the US, 18 million in North and South America, excluding the US, 28 million in EMEA, and 23 million in APAC. Their cost of goods sold, or the expenses directly tied to generating the revenue, is 97 million. So their gross profit is 44 million. Gross profit margins were 36.5%, now it's 31.3%. Operating income, 11.6 million. Their operating margins are 8%, half of last year. Last year was 16%. Net income is also down a lot. It was 21 million, now it's 9.6 million. It was 12%, now it's 7%. They have pretty much the same shares outstanding as last year, 4.9 million, but their EPS is down a lot. It was $4.33, now it's $1.95. EPS is net income over shares outstanding. So if you own one share, your portion of the net income is $1.95. Let's take a look at the statement of cash flows. Operating cash flow 5.8 million, down from 25 million. Operating cash flow is net income plus 5 million of depreciation minus 8.6 million of changes in working capital. In their investing section, they spent 3.9 million of capex and they received 3.2 million on the sale of capex. Last year, they spent 14 million on acquisition. This year, they didn't do any acquisitions. At least not any acquisitions that showed up as cash on the statement of cash flows. Here's their acquisition last year. On February 2023, they acquired Pilot Plastics. That's headquartered in Akron, Ohio. Pilot Plastics is an injection molding manufacturer. The purchase price was 13.8 million. To fund the acquisition, they borrowed on a credit facility. Here is what they received from the acquisition. They received their accounts receivables, 1 million. So what Pilot Plastics customers owe them, those payments will go to this company. They received 585,000 of inventory, 13.6 million of PP&E. They also owe 1.3 million on accounts payable. So PLPC will assume that. The identifiable net assets is 13.8 million. So it doesn't look like there was any goodwill added from this acquisition. It's mentioned right here. No residual goodwill was recognized. In their financing section, they paid back 5.3 million on a bank note. They borrowed 33 million of long-term debt. They paid 33 million of long-term debt. They paid 1.1 million of dividends. So in their financing section, they had a cash outflow of 12 million. Let's look at the company on Simply Wall Street. Its last price, 132, 647 million market cap, up 3% in the past week, down 23% in the past year. They started trading back in 1995. It looks like it was 17 a share. After 3 years, it doubled. It fell to its lowest point, it looks like in 2003, a little under $14. And then it's done really well since then. There were some ups and downs. The peak was over 180 in mid-2023. So it's come down a good amount since then, maybe about 25% or so. Simply Wall Street's valuation is $14. They say the stock is really overvalued. No analyst priced this stock. Their revenue in 2013 was 428 million. Then it came down to 340 million in 2017. Then in 2020, it got to 2013 levels again, and it peaked at 700 million in mid-2023. The past few quarters, it has come down. It's 629 million in the trailing 12 months. Most years, they have positive free cash flows, but there have been some time frames it's been negative. They had their highest ever in 2023, 72 million. This red line is their debt. It was 12 million in 2013. It peaked at 89 million in 2023. It's down a little bit, down to 56 million currently. And this blue line is their equity, which is always a lot higher than their debt. And the green line is the cash. They have a similar amount of cash as debt. Their dividend back in 2014 was 1.5%. By 2015, it was over 2%. But the stock has done really well, forcing the yield to go down. The current yield is 0.6%. The CEO's salary went from 365,000 to 600,000. Total compensation 1.9 million. Tenure as CEO less than 1 year. 46% of the company is owned by institutions, 29% by private companies, 13% by the general public, and 12% by insiders. It looks like Barbara Ruhlman's Revocable Trust and another trust owns a big percent of the company. This must be the founder of the company, because there's other Ruhlmans on this list. Some bigger companies own the stock, like Invesco, Northern Trust, BNY. Their employee count is up from 2,800 to 3,500, and the ticker trades on the Nasdaq and Deutsche Börse. Let's look at the stock on this website I use, Business Quant. They value the company at 49 out of 100, so they say they're not really over or undervalued. Growth is also mid-scale. Health score is high, 82. A high score indicates good liquidity ratios. Their Business Quant score is 63. That's just the average of these three scores. The blue line is their price to earnings. The light brown is their price to sales. So their price to sales is getting on the higher side. It was as high as 1.15 in mid-2023. It's a little over 1 now. It was 0.5 back in 2020. The PE is looking really attractive. In 2015, it was over 30. Now it's getting to its lowest levels, or close to the lowest levels. These gray bars are their quarterly revenue. It is an uptrend overall. 2023, they had their best quarters. They've been coming down a little the past few quarters. The blue line is their percent growth. Their growth is pretty minimal now. It was pretty good last year, over 20%. Gross margin of 31%. It was a lot better in 22 and 23, in the mid 30% range. But gross margin was a lot lower in 2019, only 28%. Here's their first quarter press release. Sales down 22%, and that's due to a slowdown in spending within the communications end market. A foreign currency loss of $700,000. Not much new here. We kind of saw most of this on the 10Q. So let me know what you think. Give the video a like, subscribe, or comment below. If you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.